Hi, this is Iris, a realtor and landlord in the Pioneer Valley, Massachusetts. Today, I will show you the tax benefit of rental properties as a part of 4 of my real estate investment YouTube video series. We just filed our tax of this year yesterday. I'm not a certified tax accountant, so you shouldn't take this video as a tax advice. If you own rental properties or are thinking of acquiring rental properties, you probably know the 3 major financial aspects of being a landlord. These are, first, monthly rental income. Second, property value appreciation. This means the value of your property goes up with time. And the third, the tax benefits of rental properties, which is our focus today. We get tax breaks for things we were going to do anyway, like buying the building in the first place, financing the purchase with a mortgage, and then maintaining the property. One big tax deduction for rental properties is the depreciation of the building. It's assumed that the building deteriorates with time, and it takes 27.5 years for its value to deteriorate to zero. This is obviously not true in the real world. We recently bought a multi-family house that was built in 1915, and its value has only gone up ever since. Nevertheless, accounting rules allow us to deduct 3.636% of the building as a business expense on our taxes every year. One thing I need to emphasize is that we can't use the purchase price of the property divided by 27.5. because only the structure depreciates. Land doesn't depreciate. So we need to take the purchase price with the closing cost and subtract the value of the land it's sitting on. This is the amount that we can depreciate over 27.5 years. Here we look at an example of the annual depreciation of a property. I bought an old house for $290,000, and the closing cost was $5,200. The house had a knob and tube wiring, which is a very old type of wiring that may increase fire risk. It's harder and certainly more expensive to buy property insurance with this old wiring. So we hired a licensed electrician to eliminate the knob and tube wiring and upgrade the electrical system. After I take the purchase price plus closing costs plus electrical work minus the land value, I got $272,200, and this is the amount I can depreciate. After I divided $270,200 by 27.5, I got $9,825. So we can cancel out the tax liability of $9,825 of our rental income every year for the next 27.5 years. Other large components of the house and the property also depreciate. These include things like large appliances, furnace and hot water heaters, landscaping, walkways, replacement windows, and a new roof. The IRS has determined how long each of these improvements lasts, and therefore how many years they can be depreciated over. Each of these things has an official economic lifetime, courtesy of the nice people at the IRS. You can find the specific numbers in the reference 1 toward the end of this video. Or you can Google IRS publication 946, how to depreciate the property. Some examples are large appliances like a refrigerator and a stove depreciate in 5 years. Furniture also has an economic life of 5 years. Landscaping such as a fence, shrubbery, or sidewalk is depreciated in 15 years. On top of depreciation, the IRS also allows tax-deductible expenses to be deducted in the year they are incurred. This includes the expense to run the property, keep it repaired, pay the property tax and the insurance, and pay the interest portion of the mortgage. Here I need to emphasize that only the interest part of the mortgage is tax deductible, not our entire mortgage payment. That's a brief summary of the tax benefits of rental properties. If you want to further study, I list 2 IRS sites here as well as a good book. That's it for today. Thank you very much for watching. You are welcome to subscribe to my channel. See you next time.